Hello, guys. What is happening? Welcome to tonight's live stream. So, basically, I was going to do a live stream tomorrow because obviously tomorrow is Good Friday. It's Easter. Yippee, yay. But I thought, you know what? Whilst it's fresh in my head and to give myself the day off, I wanted to do the weekly kind of wrap up today. Obviously, a lot happened this week. We just want to see how markets have sort of reacted through this week. It's not going to be a very long live stream, I don't think. I always say that, and then we end up like 30 minutes, an hour later. I don't know how time flies so much. I guess time flies when you're having fun. And I do have fun doing this. I do enjoy it. That's why I come here and I keep doing it. But, so we're going to look at the markets right now. Now, one thing I want to show you, and should be alarming to people, but it's happening very much in the shadows. People don't really know it's happening. And oh God, there's that guy. It's corporate debt. This is some of the bonds that I watch of corporate debt, and they are down significantly. XCB, this one right here, iShares Canadian Core Corporate Bond Index. I just want to show you where this is at because this is sort of just crazy. So you had basically it opened at 1986. It's finished the week down lower. Is that Steve? Says Trent. You saw him too. I was too slow there. It was the famous Steve Starsky. Everybody corrects me when I say that, but I mean, it sounds like a better name to me than Suretsky Starsky because he is the star of the show. He is the real estate journalist of Canada, and Mr. Fool's in the house. That's nice to see. Haven't seen you, sir, in a while. So, anyways, this XCB.Toronto, as you saw, most of the corporate bonds were down. So this was down significantly on the week, but let's see how it is performing historically. So it's down on the month, it's down on 6 months, it's down on 1 year, and it's also heading to the lows for the past 5 years. But let's string that out even more, and you can really see the damage. You're talking about May 2009. That's where we're at right now at this 1961. That's really where it last hold. The blip that we saw in 2020 was so quick, the downside, so quick, the upside. I wouldn't even really count it. But you can see the last time it was actually sustained down here was in May 2009. So that just goes to show you. Now, if you think about private debt and how much private debt has risen, and when we talk about these bonds falling in price over such a long period of time, a lot of people probably are confused what I'm talking about with that. But basically, when a bond falls in price, so this bond, for instance, is what is it? It's iShares Core Canadian Corporate Bond Index. I think a lot of the holdings are of the big banks. I'm not sure why it's not. Oh, here we go, holdings. So if we go over here, you can see the weightings, and it doesn't look like it. Oh, it's got some. It doesn't look like it's very accurate, but you can see here it's the banks. It's the big banks that this bond is basically got. Most of the top holdings are the Royal Bank of Canada, all these banks. So it is 5% of that bond. So, and they're the top holdings in this bond are the big banks. So the banks are paying more for their debt as well. But just looking at the chart, like this bond goes all the way back to 2006, and you are below the price when this bond started, which was in 2006. You're actually below that right now. So as a long-term hold, it just goes to show the damage that has been done by this bond market sell-off. And what really people need to understand is bonds moving lower in price means the cost of debt is going up for corporations. That means that they have to either pass that on to consumers or cut their overheads or find a way to pay back that debt. Like there is definitely a consequence of the bonds going down in price, albeit it's going to come and ripple into the economy slower. Like you're not going to see this instantly take effect. And really, this has happened so quickly when we really think about it, because the bond was actually holding strong until here, September 2021. So we are in April right now. So yeah, not that long ago, like 6-7 months ago, that's all. So we're not going to see the effects of this bond market sell-off because it has happened, even though it's sustainably happened and gone down, and it hasn't just crashed, but it has happened in a short period of time. Like these things take a while to ripple into the economy. And this is a Canadian bond, and bonds are going to go lower, in my opinion. They're not yielding. If you look at the yield on this bond, it's 2.91%, which isn't that high. If you look at the yield on junk debt now, I think it's up around 4.5%. So if we go over here, and all the bonds are down significantly. And if you look at this investment grade LQD, it's interesting because BlackRock is one of the top holdings in this corporate bond. You know, BlackRock stock is being pummeled at the moment, but you can see again this bond dropping way lower, and you can see it's dropping right down to the lows, and it's going to go lower in my opinion. And this has really took a sharp dive down. And these bonds, like they're paying 2.48%, way below what inflation is. And that's what I want to be making clear here. These bonds are paying less than inflation. So and JNK finished the week. Did it finish the week in decline? Pretty much flat by the looks of it. Oh no, it did go down. So J&K down on the week, but we were down at 99.20. So even junk debt, people just aren't interested in it, despite the yield here of 4.47%. People just aren't interested because the inflation is running so high, and these central planners and central bankers, what are they going to do about this? What are they going to do? They're going to raise interest rates, try and control inflation. But, you know, that is going to collapse the economy. And again, like that won't become evident until further down the road. Like the effects of the hikes are not going to be instantaneous. I know a lot of people like to think that they are going to be, but they're not. But when you look at bonds and what's happening in the bond market, it's really clear to me. And one of the things that is like the best indicator for a recession that's coming is the yield curve. And let's take a look at what the yield curve is looking like. So we got the 1s, the 2s, the 5s, the 10s, and the 30-year. And you can see clearly that the 5-year is inverted over the 10-year, the 10-year over the 30-year. So you've got, for a 30-year bond, if you lock your money up for 30 years, you're getting less of a yield than if you lock it up for 10 years. So that just goes to show how ludicrous this has really gotten right now. It's just kind of insane to me. And I think at one point today, was it today or was it yesterday? The bond was even lower. Like it was, yeah, like it actually rose significantly at the end of the session. But today it was right down at 2.63. The yield curve had completely inverted across. Even the 30-year was below. The yield on a 30-year bond was below the 5-year at one point today. So that's like a 90% that's like a 90% probability of a recession, because 10 out of 11 times when the yield curve has inverted in the past, it has resulted in a recession, and it inverted in 2019, and then the cerveza sickness happened. Now, the fact is, Canada was heading into a recession likely in 2020 anyways, due to the fundamentals in the economy and what was happening. And then the cerveza sickness happened, and there was like a recession, but it was very small and short lived, if at all. Like, most people didn't really notice much of a recession that happened in 2020. But this next recession is going to be much more sustained. Interestingly enough, the Canadian dollar versus the US dollar. Actually, let's have a look at the reaction, because this is the currency. So normally what you would see is the currency would go up when they raise interest rates. So let's have a look and let's see. So if we look at the currency on the week, it's down. The currency is actually down. I don't know what is going on with this chart. It's a complete mess. Like, it's saying it's Friday, the 15th of April. I don't know what time zone this chart is on, but it's not Eastern time. It's not Mountain time. Okay. Why? It still thinks I'm in England. That makes sense. That makes sense. Why the charts? I don't know why, because I didn't take this computer to England. Bizarre, really bizarre. But anyway, you can see that the Canadian dollar is down on the week, even though they raised rates. And when they raised rates, it did have an effect, an immediate effect of pumping the currency, and then it's come back down. So it begs the question, why is the currency moving down if everything is hunky-dory in the economy? Surely rising interest rates, rising bond yields, that's a reason for people to be buying the Canadian dollar. And the fact is, guys, that Forex markets, they know that Canada is an incredible amount of debt. We know this as well. So if we go to, we've been to this chart a million times, trading economics, private debt to GDP, but I'm going to pull it up again. And you can just see here that private debt to GDP is massive. It is absolutely colossal. And this is the debt held by the private sector. So people know this, like, all the charts are out there and whatnot. People can see the amount of debt that corporations are holding. So the cost of servicing that debt has risen to not just like pre-cerveza highs, like decade highs. And they are holding the most debt they've had in history. It is a recipe for disaster. And then you've got the households who are also holding a bag full of debt. If you look at trading economics, debt to income, you can really see how it's just completely out of whack. So let's just take a look. That's debt to GDP. I want debt to income. Can't find it. Oh, here it is. It's right there. So there you can really see debt to income really shows how much debt people are in. They are in a ton of debt. So there was some paying down of the debt. Well, no, there wasn't actually. That was just where incomes dropped. No, yeah, that would have been, yeah, no, I'm trying to think. I can't remember exactly why there's drops after 2020, but you can see that that has indeed reversed and gone up substantially. I think during the first part of 2020, people were paying down debt when government transfer payments, stimmy checks were going out and everything like that. But that quickly obviously reversed in 2021. And you can see that right now on this chart. And if you compare that to a country like New Zealand, well, they're very similar actually. So it's very, very interesting. I think all of this stuff is kind of like just creating a tornado, which is just going to plow through the economy. Like, you cannot have debt servicing costs go up as much as they've gone up for businesses and households, and there is no repercussions of that. Like, it's just not possible. And that's why the yield curve is inverted. The yield curve, they know this is going to come down the road. Now, it's really a 50-50, a roll of the dice to the government's response to when the recession hits and the central bank's response to when the recession hits. We've gone through it many times on this channel. But I think it's interesting, nevertheless, to see what's going on. Now, I think the bonds actually finished slightly down, the government bonds, like maybe a couple of basis points, like 1 or 2 basis points. I think the 5-year fell on the week like 1 or 2 basis points, something like that. But fixed rates are moving up. Again, variable rates are going up. Like, all these things, people are just getting attacked from all angles. And it's really going to come to fruition over the next 12 months. It's really going to be able to see. And when we start to see the front end of the curve, the front end of the bonds, if they start to drop, like we start to see the 5-year dropping, then we know that the recession is imminent. We know there's something that's coming down the pipe that's going to happen. And the big 5 banks, heavily exposed to real estate markets, most of their business. It's going to be very, very interesting to see what happens going forward. Anyway, guys, I don't want to keep you on here any longer. I'll let you all enjoy the rest of, well, not the rest of your Easter. Easter has only just started, hasn't it? But anyway, keep an eye on these things. Keep an eye, put a watch list together so you can keep an eye on these different things. But it's really, really interesting. It's something we got to keep tabs on: the bond market, the corporate debt market, everything like that. Incredibly important. Anyway, guys, thank you so much for watching. I'll see you in the next one. Peace, guys. Bye-bye.